So you've watched Chapter 4, you've got your defensive portfolio all set up. You have your 50% in bonds, which is your shield, and your 50% in stocks, which is your sword. But now you have a new problem. There are over 4,000 public companies in the US alone. Which ones do you actually put in that stock bucket? Do you buy the hot new AI startup everyone's talking about? Do you buy the company your uncle recommended at Thanksgiving? Or do you just throw a bunch of darts at a board and hope for the best? Benjamin Graham says, stop guessing. Graham hands the defensive investor a very strict checklist. He basically says if a company doesn't pass these 4 tests, you are not allowed to touch it. No exceptions. Today, we are going to learn how to build a portfolio that is bulletproof, boring, and, most importantly, profitable. Graham knows that the defensive investor doesn't want to spend 40 hours a week buried in balance sheets. You have a life to live. So he created a simple but powerful filter to weed out all the trash immediately. These are the 4 rules of entry, the 4 non-negotiables for buying a stock. Rule number 1 is adequate diversification. Graham says, don't be a hero. Never ever put all of your money into just 1 or 2 stocks. It's a recipe for disaster. He suggests holding somewhere between 10 and 30 different companies. Why? Because even a fantastic company can run into unexpected trouble. A scandal, a major lawsuit, a terrible CEO. Anything can happen. Think about it. If you own 30 companies and one of them goes completely to zero, you only lose 3.3% of your total stock portfolio. It'll sting, but you'll live. If you only own 1 company and it goes to zero, well, you might be moving back in with your parents. Diversification isn't just a suggestion, it's your seatbelt. Rule number 2 is what I call the big and prominent rule. The defensive investor should not be hunting for hidden gems in the penny stock bin. That's a speculator's game, and it's a dangerous one. Graham wants you to buy large-cap companies. He wants industry leaders, the kind of companies that literally everyone has heard of. Why? Because when a recession hits, and it will, the small speculative companies are the first to go bankrupt. But the giants? They usually survive. They have the brand power, the customer loyalty, and the financial muscle to weather the storm. We're talking about names like Coca-Cola, Johnson & Johnson, or Walmart. These are the battleships of the market, not the flimsy canoes. Rule number 3 is conservative financing. This is the safety check, and frankly, it's the rule that knocks out most modern tech stocks right away. Graham demands financial strength. For industrial companies, he wants their current assets to be at least twice their current liabilities. What does that mean in plain English? It means for every $1 of debt they owe in the short term, they should have at least $2 of cash or stuff they can easily sell for cash sitting in the bank. This is the classic current ratio. It's a quick test to see if a company is financially sound or if it's drowning in debt. If a business is highly leveraged and one bad quarter away from a crisis, the intelligent investor simply walks away. It's not worth the risk. And finally, rule number 4 is the dividend record. This is my absolute favorite rule. Graham insists on a long, uninterrupted record of continuous dividend payments. Specifically, he asks for at least 20 years of non-stop payments. Why is this so important? Because earnings can be faked. Accountants are clever, and they can legally manipulate profit numbers to make a company look healthier than it really is. But dividends are real cash. You cannot fake a wire transfer from the company's bank account to the shareholders. It's proof. If a company has successfully paid you cash every single quarter for 20 straight years, through recessions and market crashes, you know you're dealing with a real, durable business, not just a passing hype train. It's the ultimate sign of a company's stability and its commitment to its shareholders. So let's recap these 4 simple yet powerful rules for the defensive investor. First, you need adequate diversification between 10 and 30 stocks. Second, stick to large, prominent, financially sound companies. Third, ensure conservative financing, with assets far outweighing short-term debts. And fourth, demand a long and uninterrupted record of dividend payments. If you apply these 4 filters, you will automatically eliminate 99% of the stocks out there. You'll screen out the speculative junk, the overhyped story stocks, and the financially fragile businesses. What you're left with is a small, elite group of high-quality, stable companies. This isn't about finding the next 10-bagger overnight. This is about building a portfolio that lets you sleep soundly at night, knowing your capital is protected while it steadily grows over time. It's the very definition of intelligent investing. I can already hear the comments, but what about Amazon? What about Tesla? They didn't pay dividends for years. They were just small companies once. And you're right. Those are great questions. Benjamin Graham actually has a name for stocks like these. He calls them growth stocks. And for the defensive investor, the investor we're talking about today, he absolutely hates them. So why the hate? It's simple. Growth stocks are priced based on anticipation. You're not paying for the profits they're making right now. You're paying for the profits you hope they'll make in the future. It's all about speculation on future growth. And the problem is, if that growth slows down even a little bit, or if the market sentiment changes, the stock price can crash. We're talking 50, 60, even 70% drops. It's incredibly volatile. The defensive investor, following Graham's philosophy, prioritizes the safety of their principal above everything else. They want to protect what they have, not gamble for a home run. Leave the moonshots and the high-risk plays to the speculators and the gamblers. Our goal here is steady, reliable wealth building, not a trip to the casino. Now think about what it took to follow this strategy back in 1949 when The Intelligent Investor was first published. You had to manually find these 30 companies. You'd be digging through newspapers, reading dense annual reports, and doing all the math yourself with a pencil and paper. It was a ton of work. But today, in the 21st century, we have a cheat code, a shortcut that I'm convinced Graham would have absolutely loved. It's called the low-cost index fund, or more commonly, the ETF. Let's break down why this is the perfect modern tool for a Graham-style investor. When you buy a broad market index fund like one that tracks the S&P 500, think of EOE or SPY. Let's see what you're actually getting. First, diversification. Does it pass the test? Absolutely. You're not just buying 30 companies. You're instantly invested in the 500 largest companies in America. So, diversification? Check. And are these companies large and prominent? Well, the S&P 500 is literally a list of the 500 biggest, most established public companies in the US. So, big and prominent? Double check. Third, what about financial strength? This is a big one. To even get included in the S&P 500 index, a company generally has to be profitable. The index has rules to weed out the weaker players. So while it's not a perfect guarantee for every single company, on the whole, you're buying a basket of financially sound businesses. So financial strength? Mostly check. But maybe you want to be even stricter. Maybe you really want to stick to Graham's rule about a long history of uninterrupted dividend payments. Well, there's an ETF for that too. You can buy something called a Dividend Aristocrats ETF. The companies in this fund have not just paid a dividend, but have increased their dividend payment for at least 25 consecutive years. Think about that. Through recessions, through market crashes, through global crises, these companies have consistently not only survived but thrived enough to give more money back to their shareholders year after year. This is the ultimate autopilot version of Graham's strategy. It does all the hard work of finding and vetting these companies for you. It's a simple, effective way to apply these time-tested principles without spending all your weekends buried in financial statements. So, with all this in mind, here's your homework for this chapter. I want you to conduct what I call a junk removal audit on your own portfolio. It's a simple 3-step process. Step 1. Open up your brokerage account and look at the individual stocks you've picked yourself. Not the funds, just the single companies. Step 2. For each of those stocks, apply the 20-year test. Has this company paid a consistent dividend for the last 20 years? A quick search online for the company's name plus dividend history will tell you what you need to know. Step 3. Apply the sleep test. Ask yourself, if the market crashes tomorrow and the economy goes into a deep recession, does this company have the financial strength, the brand, and the cash on hand to survive? Can you sleep soundly at night owning this stock through a crisis? Be honest with yourself during this audit. If you find you're holding a company that has no earnings, is not paying a dividend, and is loaded up with debt, then you are violating the core rules of the defensive investor. You're not investing, you are speculating. And as we learned in the very first chapter, speculating is perfectly fine, but only with your casino money. That small portion of your portfolio you're willing to lose completely. You should never ever confuse your speculative plays with your life savings. Your core portfolio, the money you're counting on for retirement and financial security, should be built on a foundation of safety and quality, just as Graham taught. So take some time this week to do your junk removal audit. Clean up the portfolio, align it with your true goals as a defensive investor, and set yourself up for long-term success. Thanks for watching, and don't forget to like and subscribe for more deep dives into building lasting wealth. See you next time.